Okay, one of the key revenue drivers for us in Q1 is the investment income. The investment income actually accounts for about 48% of our revenue. So we saw in Q1 rates trending downwards in the treasury asset. But what we've been able to do as a business is to optimize and efficiently manage our investment portfolio. So when we saw that rates were trending downwards, we looked out for other alternative assets that we can use to optimize our yield. So that's why you can see that between 2018 Q1 and 2017 Q1, there was a slight improvement.
Okay, so you just said you saw other investment options that you could use to optimize your yields. Which ones were these?
Okay, we saw a lot of CPs in the market in Q1. Different banks came out with CP and other blue chip companies coming out with CP. So
commercial papers?
Yes.
Okay.
So while the yields were not comparable to what we had in Treasury bill at the beginning of Q1, but it was fair enough because we saw rates trending downwards towards the end of last year. So you could also ensure that, okay, if rates are trending downwards, these are also an alternative way to ensure that you're still maximizing and ensuring that you still deliver on the numbers.
What about your equity portfolio? I know that was also a key contributor to the top line.
Okay, so the equity portfolio accounted for about 9%, 190 million in Q1. So with the effect of IFRS 9 financial instrument standard, what we realize is that, with the new standards, if you have an equity investment that you are accounting for as AFS, available for sale, in other words, the gain or loss of those assets are impacting your reserve. So if you hold those assets for short-term value, why are you keeping it there? Because the new standard says that if you hold this asset as AFS, in other words, the gain is impacting on your reserve. When you dispose those assets, you cannot recycle that gain to your P&L. So one of the business decisions we took was to ensure that if these assets that we are holding initially to impact our reserve and therefore short-term value, why do you keep leaving them there? Why not account for them as a trading portfolio? So that's what account for that 190 million additional income that we recognize in our numbers.
I want to move on to another line item on your income statement. It says operating expenses went down about 18 million. How did you, I know that a lot of companies are looking to streamline in this process, but then I know that your operating expenses have actually been trending downwards over the past year. So how have you continued to do this?
Okay, the truth is that why we want to grow the revenue aggressively, we ensure that you don't do that, putting too much cost on the table. So we look out for expense line that, okay, for instance, travel. If you have to travel for a meeting, probably in Abuja or Port Harcourt, where we have a regional base, why do you have to go from the Lagos office? Why not use your regional hub to take those meetings? And then if you have to join in, you can join in through other channels. So costs like that, travel cost, other areas that we know that we can, there are other alternatives that you can use to ensure that you manage that. Those are things we deploy in Q1 to ensure that we don't ramp up on our cost.
Yeah, let's also talk about share, because it also says in part of the income statement that you expanded your business and product offerings to gain more market share across your diversified business lines. Tell us about that.
Okay, around this period last year, we launched 2 mutual funds. So we launched those funds in this same period last year, but the effect of those funds you're beginning to see in the numbers. So for the mutual fund now, as at Q1 last year, we didn't have that increased size from the additional new fund. So this year now, your management fee will definitely improve by accounting for that additional increase in fund size. So in addition to those 2 product lines, we also leverage on technology. We've revamped up our technology in order to be able to drive up our retail products. So we had an improved Invest Now tech platforms that we are using to push out a lot of our retail products to ensure that we consolidate on the market share in that space. So that is also translating to increased numbers in the retail side.
So let's talk about the outlook now. So Q1, a good start, a moderately good start according to your CEO. How do you expect Q2, Q3, and Q4 to play out with this start?
Okay, like I said earlier, one of our strategic objectives for 2018 is to consolidate on our market share in the retail space. Okay. Now we want to get to a point where you have significant fee income coming from your brokerage, from your retail clients. You want to have significant fee income coming from your private trust fee, coming from your mutual fund. So the technology is what we are really pushing forth this year to ensure that we can consolidate on that space and ramp up on fees from those different product lines.
But still on that, I'm thinking about, the opportunities also that you see, perhaps other opportunities that you see in the economy, deals in the pipeline in the not-too-distant future? What do you have your eyes in?
Okay, well, in Q1, we saw there were no real investment banking transaction. What you saw was commercial papers.
Okay.
We're expecting that with the new regulations coming in, probably if the SEC board is set up properly, we can have transactions begin to get approved, and then we see more transactions coming in. With the MTN listing, I think it will open up the market for more opportunities in the investment banking space.
How do you feel about the economy right now?
Well, it's a mixed side. There's the uncertainty around it, with the president announcing his desire to contest next year, with the capital market space not having a strong board in the SEC. I think the economy is still very much uncertain. But the point is, as we begin to get in Q2, maybe probably early Q3, we can see improvement, and that will translate to a lot of more opportunities open up for us.
Now let's move to the equities market specifically. Q1 was fairly, disappointing.
Yeah.
It was a strong start. We surged to about
January.
40%, and then it just trimmed all the way down to about maybe 7%. That's at the end of Q1. What do you see happening in Q2? And this is for your sheet, because if Q2 is as bad as Q1, I imagine that will be a bit tough.
Okay, the expectation is that as the banks begin to release their Q1, we'll see how the market will rally. Now, I don't think there's so much excitement right now, because there are a lot of factors beyond just the earnings of banks or companies that are impacting on the markets. There's a lot of sentiment to a large extent. So while the point is we are actively looking out for opportunities. So when we see that there's a rally like we saw in January, and we took a lot of advantage of that, and you can see that now improving. So we are looking actively. We're not just waiting and say, okay. So when we look at it and say, oh, these are opportunities. This opportunity may not stay for too long. We enter in. So, but we expect that while the rally will be there, it may not be as much as what it was in January.